Right, this video is going to take on a very topical subject, which is how do we stop banks going bust? In the wake of the Lehman's disaster, governments and all sorts of other people have looked at this problem. For the time being, of course, we have several banks bailed out by the taxpayer in the UK, but long term, how do we stop it happening again? And the latest proposal to come out of the Treasury is something called ring fencing of retail banking. So what is that? And is it likely to work? Okay, so basically to talk about ring fencing, we need to talk about what banks do and just identify where the problem's thought to be. So a typical large bank these days can be broken down very crudely into retail banking and the slightly sexier sounding investment banking. Now, these are very broad headings. This one's also known as merchant banking, but in essence, retail banking can be stripped down in bare bones terms to taking savings off people, apologies there, and making loans using those savings and loans. So retail banking in its most basic form is people put money in the bank. Now, banks are quite clever. What they do is they reckon that if I put £100 into the bank now, I'm not going to walk in tomorrow and ask for £100 back. I might walk up to the cash point machine tomorrow and ask for, say, £10 back, but I'm unlikely to ask for the whole lot. So, having taken my savings, they stick £10, let's say, in the cash point machine, simplifying obviously there a little bit, and the other 90 I've just given them, they can lend out. And that ability to create credit off the back of deposits is quite a useful part of what banks do. And it helps to explain why all the talk about which parts of banks to ring fence and so on focus not just on deposits but on loans because of credit creation using bank deposits. So if retail banking is the kind of steady cash cow business of taking deposits, paying an interest rate on them, lending the money out, presumably at a higher rate, and that money can be lent out in the form of personal loans, mortgages for example, and corporate loans to companies. That basically is half the story for a lot of banks today, because retail banking has often been merged now with investment banking. There are banks out there, HSBC for example, Barclays, which do both. Equally, there are banks out there that just do this, largely, Goldman Sachs, JP Morgan for example, and prior to it going bust, you had Northern Rock, you've got the building societies that largely focus on just the retail side. And the problem is thought to be, in a way, the combination banks, the ones that do a bit of everything. Because investment banking is a whole raft of activities that I cover in another video, but it includes M&A, taking a fee from corporate clients for advising on deals, the timing, the price and so on, new issues, advising on IPOs and the like, and also dealing, also known as proprietary trading, risking the bank's own capital, hedge fund style, to make money. And that could be in any number of markets, foreign exchange, shares, bonds, swaps, you name it. Now, latest proposal is essentially this. What the coalition are thinking of doing is saying retail banking needs to be quite literally ring-fenced. Now, Vince Cable would like to go a little bit further than that. He's proposed a complete split between retail and investment banking. So ring fencing isn't that, it's a kind of halfway house. And most of the issues surrounding this idea of ring fencing surround what are you going to ring fence? What activities are we talking about? If it's retail banking, what does that mean? Secondly, how's it going to work in practical terms? And thirdly, will it make any difference? Will it make a bank less risky or possibly even more risky? So, to answer those three questions, how's it going to work? That's a good question. That's being chewed on at the moment. How do you separate out retail banking and ring fence it in a way that will keep regulators happy from the sexy high-risk investment banking stuff? Answer, in practical terms. You can identify the people that work in that area. Let's say there are 1,000 of them. You could put them in a separate building. You can design IT firewalls and blocks. You can have security cards that only let people into certain parts of your organisation. You can do all kinds of things in practical terms to try and demonstrate that you have literally fenced off the people who work in retail banking that's meant to be safe, boring, staid, low risk, from the people who do the sexy stuff in investment banking. So, in practical terms, the so-called Chinese walls, artificial barriers to people who shouldn't talk to each other, talking to each other, could, in theory, be set up by the big banks. Only problem with Chinese walls, of course, is they don't work so well down the pub on a Friday evening when you're not in the bank anymore. But in theory, it's possible to keep people separate at work who it'd be better if they didn't talk to each other. Now, what is retail banking? And then we'll talk about what the point of all this is. Retail banking, good question. There is some debate about this at the moment. How much of a bank are you ring fencing? Is it, on the loan side, is it just loans to individuals? Does it cover corporate loans? Some of those can be quite high risk. Does it cover government transactions, derivatives? In other words, what's in here? Because if you do include all personal loans, all corporate loans, government-related transactions and related derivatives, you could be talking, for some of the bigger banks, about 60 to 70% of what they do. Well, that's an awful lot to try and ring fence. Because, here's the point, once you've identified what activities are retail banking and how you're going to ring fence them, the point of the whole of this whole proposal is this needs to be kept safe. In other words, this might be the bit the government is prepared in some way to underwrite and save. If a bank gets into trouble, this mob can be fed to the wolves, if you like. Investment banks can and should be allowed to fail. So the idea is that you, in some way, separate the low risk and the high risk stuff with a view to only ever having to step in, potentially, and save this bit. Now, in order to minimise the risk that anyone's got to step in and save anything, the proposal is this. We need some more rules covering the retail banking bit of a large bank. So, one of the key rules that's being proposed is that the minimum capital requirement be raised to 10%. If you like, and this gets a bit technical, but I'm going to keep it fairly simple, a capital requirement is a sort of rainy day fund, if you like. And the higher this bar is set by regulators, in theory, the safer that bank or bit of that bank should be. In essence, this is a calculation about how much capital a bank has in reserve should things go wrong. And the idea of these proposals, the ring fencing, is that you take retail banking, separate it out, and then subject it to a higher test. And it's just worth a word about what this actually would do. Basically what we're saying here, the formula says if you take a bank's own funds as a proportion of its risk-weighted assets, you're looking to beat, let's say, some target, 10%. Now the current target, simplifying slightly, I'm not distinguishing between sort of core, non-core and so on, or tier 1, tier 2, but current target's around 7%. This requirement could raise it to 10% for the retail banking bit. So you set the bar higher. How does this help? What does this do? Well, own funds is essentially money the bank has raised itself from issuing shares and past profits. So for argument's sake, that could be 100 million. Let's make up a number. Risk-weighted assets works roughly like this. A bank's assets include mortgages. When it lends you money, the fact you owe it money is an asset in its books, provided you pay up. So let's say there are 100 million of those on the bank's books. It might have corporate loans outstanding. This is companies that owe it money. Let's make that another 100 million. And maybe on outstanding derivatives contracts, the bank is owed another 100 million. Okay, so in theory, total assets on the bank's books, simplifying here, 300 million. Now the risk weighting is this. mortgages are low risk. And the reason for that is, although the bank is owed 100 million, most of that is probably secured on property. So if mortgagees don't pay up, the bank can seize those properties. So the risk is quite low. So the risk weighting might be 0. Corporate loans are riskier. So let's assume I put a risk weighting on here as a regulator of 50%. It's almost saying that half of them might never be recovered. And derivatives, who knows, seat of the pants stuff, weapons of mass destruction. So let's put a risk weighting of 100% on those. And I am making up these percentages here. Essentially, that turns 100 million into 0. In other words, we're not worried about that very much in risk terms. Corporate loans into 50 million. And derivatives, the risk weighting is 100%, so that stays at 100 million. So in other words, we have 100 million of own funds, 150 million of risk-weighted assets. Well, that's fine. 100 over 150 is around 66.6%, which is clearly a lot more than 10. So we've exceeded the target. So regulators will be happy. If there's any danger we're going to slip under that target, what will we do? Dump some risk-weighted assets, I suppose, or raise some more money. So that's kind of the principle on which those capital requirements work. So the idea would be that the ring-fenced retail bank bit is set a higher target, 10% of the number being bandied around, and that in theory would make it a safer unit than the rest of the bank. Now, will this work? Several issues being chewed over at the moment. One, what do we define as retail banking? You know, how much of a bank's activities are we going to try and ring-fence? Because think about it, some banks go bust quite happily without any investment banking at all. Northern Rock, for example. RBS, before it started dabbling with the ABN AMRO takeover. Number two, will this help? In other words, ring-fencing part of a bank, potentially quite a big part of a bank, and saying, well, that's the bit that might get some kind of bailout if things go wrong, could encourage it to take even more risks. I mean, after all, retail banking isn't always low risk. Mortgages can be lent at huge multiples of your salary, interest only, self-certified. So what's to stop people in the retail banking arm, underpinned by some sort of bailout promise, just going mad and taking bigger risks even than the investment banking side of the business? And thirdly, people have sort of said, well, you know, why should there be anything that underpins these big banks? I mean, hedge funds don't get the same sort of implied or actual guarantee. So why should an organisation that includes high-risk activities such as a bank get any sort of implicit guarantee? So on that basis, there are plenty of people who wonder really, in practical terms, how this ring fencing is going to work. One thing you can say is the regulatory cloud hanging over the banking sector makes it a fairly hairy place to put your money right now. Because who knows, this might go through, this might actually happen, we might go back to some kind of separation of retail banking, investment banking, but all this regulatory uncertainty, regulators gunning for the banks, really makes it quite a tricky sector to find any kind of true bargain in right now.